What if I told you some of the world's biggest companies are trading at a discount, overlooked while investors chase hype? These industry titans have strong balance sheets and consistent profits, yet are ignored by the crowd. Today, we'll break down 3 undervalued giants, leaders in healthcare, global communications, and semiconductors. Watch till the end for a potential game changer for your portfolio. Hit the like button, let's get 1,000 likes on this one, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Let's kick things off with Abbott Laboratories, ticker symbol ABT, a true healthcare powerhouse. The company trades at 16.6x earnings with a 231.4B market cap. Well below its historical average despite strong performance in its Freestyle Libre diabetes monitoring franchise and growing diagnostics business. Abbott has been a cornerstone of healthcare for over a century, operating across diagnostics, medical devices, nutrition, and pharmaceuticals. Their innovations, from infant formula to life-saving devices, touch millions every day. Abbott's diversified business model brings stability and growth, even in uncertain times. Investing in Abbott means supporting a legacy of innovation and a healthier future for all. Abbott is a fantastic company, but what makes it an undervalued stock right now? It all comes down to the price-to-earnings ratio, or PE ratio. The PE ratio is the company's current stock price divided by its earnings per share. It's a quick way to gauge how much investors are willing to pay for each dollar of profit. A high PE ratio suggests high future growth, while a low PE ratio can indicate undervaluation. Abbott is trading at a PE ratio lower than its historical average and its peers. This is where the opportunity lies. The market seems to be pricing Abbott as if its growth is going to slow down dramatically. The demand for healthcare is only going to increase as the global population ages. Abbott is perfectly positioned at the center of these powerful, long-term demographic trends. The reason for this temporary discount can be traced back to the post-pandemic normalization. Abbott was a massive provider of COVID-19 tests, leading to a temporary spike in revenue. As demand for those tests declined, some investors sold off the stock. This is a classic case of the market throwing the baby out with the bathwater. They're focusing on the short-term decline rather than Abbott's strong underlying growth. This is exactly the kind of market inefficiency that savvy investors should be looking for. You have a world-class company with a durable competitive advantage and exposure to massive long-term growth trends. Yet, because of a temporary decline in one area, the stock is being offered at a discount. It's like a high-end designer store having a sale because last year's best-selling item is no longer in season. The underlying quality is still there, but the price is temporarily lower, creating a fantastic entry point for long-term investors. Now let's talk about the future, specifically looking ahead to 2025. Why is this a pivotal year for Abbott? Well, with the noise from the pandemic-related sales continuing to fade into the background, 2025 is when the true strength and growth trajectory of Abbott's core business will become undeniable to the entire market. Analysts are projecting a solid acceleration in revenue growth driven by the company's powerhouse medical device and diagnostics divisions. These are not speculative projections. They're based on the continued adoption of Abbott's market-leading products and the launch of new innovative technologies that are already in the pipeline and awaiting regulatory approval. One of the biggest drivers of this growth will be the aforementioned Freestyle Libre franchise. The market for continuous glucose monitoring is still enormous and underpenetrated, and Abbott is a clear leader. As they continue to expand into new geographies and secure broader insurance reimbursement, the growth runway for this product alone is massive. But, it doesn't stop there. In their structural heart division, devices like the MitraClip, used to repair leaky heart valves without open heart surgery, are seeing incredible adoption rates. These are high-margin, life-saving products with very little competition, and they're set to become a much larger contributor to Abbott's bottom line by 2025. Furthermore, we need to consider Abbott's massive presence in emerging markets. As wealth increases in countries across Asia, Latin America, and Africa, so does the demand for higher-quality healthcare, nutrition, and diagnostics. Abbott has been strategically investing in these regions for years, building out the infrastructure and sales channels to capitalize on this trend. By 2025, these markets will represent an even larger percentage of their total revenue, providing a powerful tailwind for growth that many of its more domestically focused competitors simply don't have. This geographic diversification adds another layer of stability and long-term upside to the investment thesis. So when you put it all together, the picture for 2025 becomes incredibly clear. You have a company that will have fully moved past the pandemic comps, a allowing its strong organic growth to shine through. You have multiple blockbuster product lines and medical devices that are still in the early innings of their growth story. You have a growing contribution from high-growth emerging markets. All of this points towards a re-acceleration of earnings growth, which will inevitably cause the market to re-evaluate its current pessimistic valuation. Investors who get in now at this low PE ratio are essentially positioning themselves ahead of that inevitable re-rating. Abbott is undervalued because the market is still focused on the fading COVID-19 test boom, missing the company's real strengths. Investors are anchoring to past peaks, overlooking Abbott's diversified, profitable business and deep competitive moat. Healthcare stocks are out of favor as investors chase tech, dragging Abbott down for reasons unrelated to its performance. For value investors, this is a rare chance to buy quality on sale, before the market recognizes Abbott's true worth. Alright, moving on to our second stock. Let's shift gears from healthcare to the company that literally connects us all. We're talking about a true titan of the telecommunications industry, a household name that provides the essential network infrastructure for millions of individuals and businesses. This is, of course, Verizon Communications, ticker symbol VZ. Verizon offers an attractive 10.1x PE ratio, alongside a compelling 6.4% dividend yield, supported by a 182.4B market cap, and steady cash flows from its wireless infrastructure. Now think for a moment about how indispensable Verizon's services are in the modern world. Your smartphone, your home internet, the network that powers businesses, streaming services, and the entire digital economy, a huge chunk of that runs on Verizon's network. This is not a discretionary product. It's a utility as essential as electricity or water in the 21st century. Verizon's business is built on a massive, capital-intensive infrastructure that is nearly impossible to replicate. They have spent hundreds of billions of dollars over decades building out a world-class wireless and fiber optic network that covers the vast majority of the United States. This creates an enormous barrier to entry. A new company can't just decide to compete with Verizon tomorrow. They would need an astronomical amount of capital, regulatory approvals, and years of construction just to even begin to catch up. This physical infrastructure is Verizon's massive, unbreachable moat, ensuring its place as one of the top players in the industry for the foreseeable future. The business is primarily split into two main segments: Verizon Consumer and Verizon Business. The consumer group provides wireless and wireline services to everyday people like you and me, including mobile phone plans and Fios high-speed internet. The business group serves companies of all sizes, from small businesses to the largest multinational corporations and government agencies, with a full suite of communication solutions. This dual focus provides a stable, diversified revenue stream. While the consumer market is known for its recurring subscription revenue, the business segment offers huge opportunities for growth as companies continue their digital transformation and demand more advanced network solutions. What's so attractive about a business like Verizon, from an investment standpoint, is the predictability of its revenue. The vast majority of its income comes from monthly subscriptions. Every month, millions of customers pay their Verizon bill almost automatically. This creates a steady, reliable stream of cash flow that is the envy of almost any other industry. This recurring revenue model allows the company to plan for the long term, invest heavily in its network upgrades like 5G, and, most importantly for investors, return a significant amount of cash to shareholders in the form of a very generous dividend, which we'll get into shortly. So, we all know Verizon is a massive and essential company. But here's where it gets really interesting for us as investors. Verizon is currently trading at a PE ratio that is not just low for a blue-chip company, but is in the single digits. Let me repeat that. Single digits. This is a valuation typically reserved for companies in deep distress or facing existential threats, neither of which applies to Verizon. To see a market leader and a cultural cornerstone like Verizon trading at such a low multiple is a clear signal that the market is overly pessimistic and has potentially created a significant buying opportunity for those willing to look past the short-term noise. So why the low valuation? Well, a few factors are at play. First, the telecommunications industry is mature, and the hyper-growth days of the early smartphone era are over. The market has become intensely competitive, with Verizon, AT&T, and T-Mobile constantly battling for subscribers. This has led to pricing pressure and high marketing costs, which has squeezed profit margins. Investors who are chasing rapid growth have largely abandoned stocks like Verizon in favor of other sectors. But they are missing the point. Verizon isn't a growth stock in the traditional sense. it's a value and income powerhouse. Another major concern that has weighed on the stock is the company's debt load. Building and maintaining a national 5G network costs an immense amount of money, and Verizon has taken on significant debt to fund these investments. The recent rise in interest rates has made investors nervous about companies with large balance sheet liabilities. However, Verizon generates massive and predictable cash flows that are more than sufficient to service this debt, continue investing in the network, and pay its dividend. The market seems to be pricing in a worst-case scenario regarding its debt, while ignoring the high-quality, utility-like cash flows that back it up. This combination of intense competition, fears about debt, and a general market rotation away from boring value stocks has created a perfect storm of negative sentiment. The narrative around Verizon has been overwhelmingly bearish, but this is where the opportunity for a contrarian investor lies. The market is focusing on the negatives while completely undervaluing the company's incredible assets, its dominant market position, and its prodigious cash flow generation. When you can buy a company of this quality for less than 10 times its annual profit, you are getting an incredible margin of safety, which is a core principle of successful long-term investing. Looking ahead to October 2025, Verizon stands out as a smart pick. By then, 5G investments will be mostly complete, freeing up cash flow. Their fixed wireless access home internet will be a major growth driver. Plus, lower interest rates could boost Verizon's appeal to investors. Buying now means collecting dividends while waiting for these catalysts to play out. Let's not forget the sheer dominance of Verizon's market position. For years, Verizon has cultivated a premium brand image, built on the perception of having the most reliable and highest quality network. While competitors have closed the gap in some areas, that brand perception remains a powerful asset. This allows Verizon to attract and retain high-value customers who are willing to pay a premium for quality and reliability. In the telecom world, customer churn, or the rate at which customers leave, is a critical metric, and Verizon has consistently maintained some of the lowest churn rates in the industry. This stickiness of its customer base is a testament to its brand and network strength. This premium positioning is not just a marketing gimmick. It's backed by tangible network performance. In numerous third-party tests and studies, Verizon's network consistently ranks at or near the top for reliability, speed, and coverage. This is the direct result of their disciplined and massive investment in their infrastructure over many years. For many businesses and consumers, especially those who can't afford to have dropped calls or slow data, the reliability of Verizon's network is a key differentiator that transcends price. This quality-focused strategy insulates them from being just another commodity provider and gives them pricing power. Now, let's talk about one of the most compelling reasons to own Verizon stock, the dividend. Verizon has a long history of not only paying a dividend, but also consistently increasing it year after year. It is a certified dividend aristocrat contender. At its current low stock price, the dividend yield is exceptionally high, often hovering in the 6 to 7% range or even higher. This means that just from the dividend alone, you are getting a return that rivals what many people hope to achieve from the stock market as a whole. This provides a substantial, tangible return on your investment while you wait for the stock price to appreciate. This dividend is not just a nice bonus, it's a core part of the investment thesis. The company's massive recurring cash flows make this dividend incredibly safe and sustainable. For income-oriented investors, retirees, or anyone looking to generate passive income from their portfolio, Verizon is an absolute standout. The combination of a deeply undervalued P/E ratio, a dominant market position, and a rock-solid high-yield dividend creates a trifecta of value that is incredibly hard to find in today's market. You're buying a premier asset at a discount price and getting paid handsomely to wait for its value to be recognized. Alright, let's get right into our third and final stock, and trust me, this one is an absolute powerhouse in the tech world. We're talking about Qualcomm, ticker symbol QCOM. The company trades at 16.0x earnings with a 178.5 B market cap, representing compelling value as the semiconductor giant benefits from AI-driven demand and new product launches, including the Snapdragon X2 Elite PC chips. If you've used a smartphone in the last decade, you've almost certainly used Qualcomm's technology. They design the chips and wireless tech that power a huge portion of the world's mobile devices. Qualcomm is foundational for the mobile revolution, and their influence is growing with 5G, AI, and IoT. They are building the future, one powerful chip at a time. Qualcomm is essential technology. They own patents for fundamental technologies in modern communication. This gives them a lucrative business model, earning royalties from their patented tech. It's like being the landlord for the entire mobile industry. Despite their critical role in global innovation, the market has been sleeping on Qualcomm. The stock has seen its ups and downs, but the current valuation looks almost too good to be true. Qualcomm is a stock you need to have on your radar. It's a classic value play with a high-tech twist, and it could lead to incredible returns for patient investors. Why is a tech giant like Qualcomm undervalued? The answer lies in market sentiment and the cyclical nature of semiconductors. Investors focus on slowing smartphone sales, but overlook Qualcomm's expansion into new markets and its world-class intellectual property. Qualcomm trades at a bargain PE ratio compared to peers like Nvidia. Its licensing business generates steady, high-margin revenue, providing a strong foundation. This undervaluation is a golden opportunity for long-term investors. The future for Qualcomm is all about 5G and AI. Fifth-generation technology is transforming everything: smart cities, autonomous vehicles, and telehealth. Qualcomm is at the center, powering this revolution with its chips and patents. Their Snapdragon processors lead in on-device AI, making devices faster, smarter, and more secure. For investors, Qualcomm isn't just a chip company. It's the backbone of tomorrow's connected world. Looking ahead to 2025, Qualcomm's outlook is exceptionally bright. The fifth-generation upgrade cycle will be mature across all smartphone tiers, expanding Qualcomm's market. More importantly, revenues from automotive and IoT will make up a much larger share, reducing reliance on smartphones and creating a more stable, diversified business. With strong shareholder returns, a discounted valuation, and powerful growth catalysts in 5G, automotive, and AI, Qualcomm offers a rare combination of value, growth, and income for patient investors. Today, we looked at three value-packed stocks: Abbott Labs, Verizon, and Qualcomm, each offering stability, growth, and real potential. But knowing isn't enough. Building wealth means turning knowledge into action and creating a portfolio that lasts. If you want to learn how to spot undervalued companies and invest smarter, check out the Value Stocks Investing Master Course. Link in the description. Which stock are you most bullish on for 2025? Let me know in the comments. Like, comment, and subscribe for more investing tips. Thanks for watching.